Good afternoon or good evening to everyone. Welcome to our Georgia Tech Homebuyer Workshop. My name is Jason Maida. I'm going to be your host for this evening. Really excited to get a chance to connect with all of you and present this content. This is our second class that we've done for our Georgia Tech alumni. Really excited to get a chance to kind of start 2024 off in this class with you. Tonight's class will be about an hour-long session. So we're going to start right now, but we'll run right about to the top of the hour. We'll weave in a Q&A session as we go through tonight's session, but we'll carve out a little bit of time at the end to kind of answer any questions that we got left behind in tonight's presentation. So we try to make this a very interactive type of class. And you know what we're doing tonight was we're trying to help educate you on home ownership and provide you with resources and support. So if you do decide to take those next steps in home ownership, you know what that looks like for you. We love teaching this class to our communities across the country. And I do know with our Georgia Tech alumni base, we are kind of spread out all across the country. So what it would be kind of really cool to kind of, as we launch into tonight's class, is just to get a sense of where you're joining us from, because we're going to go over some market data in tonight's class to kind of talk a little bit about home prices and what's going on with those. Primarily focused in the state of Georgia, but I would love to know where everyone else is joining us from. So if you have a minute, just hop into the chat, just kind of put in the chat where you're joining us from. And that would be really helpful for me when we get to the market data portion to learn a little bit more about kind of, where everybody's joining us from. And then, by the way, with our Q&A, go ahead and use the Q&A function for any questions that you have as we go through tonight's class. And then I'll be answering those the best I can on air. My partner, Ken, will also be helping us out as well as we go through tonight's class, okay? And thanks for dropping in the chat and sharing with me where you're from. Okay, so we're kind of everywhere. So we got Atlanta, Bay Area here in California, LA, Houston, North Atlanta, Chattanooga. Oh, this is cool. Okay, awesome. Love it, love it. Tennessee, I'll be out there in just a couple months, so love it. Denver, okay, Boston. All right, so this is awesome. So this gives me kind of a good sense, and I appreciate everybody putting all their information in the chat. So as we know, everybody's kind of housing market looks a little bit different, right? But there's a lot of similarities too, and we'll talk about that in the housing portion of tonight's class. So just a little bit about me. So again, my name is Jason Maida, in case you missed it. I'll be your presenter for tonight. And so I get a chance to teach classes like this through our partnerships all across the country. So we generally do a class once or twice a week, focusing on just creating resources and education for home ownership. So if you do decide to take those next steps in home ownership, you'll know what that might look like for you. I've been doing this for over 20 years, but really love what I do because I get a chance to help you with the largest financial decision you're probably going to make. But we do it through educational support. And that's why, again, we teach these types of classes. We are a California-based organization, but we are licensed all across the country. So whether you're in Atlanta, whether you're in New York, whether you're in Tennessee or out here in California, we can be here to help support you. We work all across the different time zones too. So, and everything is done via video, just like we're doing in tonight's class. So obviously in today's day and age, working video is primarily where most businesses work, but just so you know kind of a little bit about where we're located. So here's tonight's class kind of agenda. We're going to talk about the housing market, which we've shared a little bit already. We're going to do a budget analysis though to launch in tonight's class. So we'll talk about that in just a minute. And then we're going to kind of look at, does buying make sense for us? We're going to look at all the benefits that come along with buying, but in some cases, buying doesn't make sense for some of us joining tonight's class because, maybe we're in a really good rent situation or we don't really have any changes that we need to make in our housing expense. We'll talk a little bit about credit. We'll spend some time looking at student loans and how those can maybe possibly impact the qualifying. We'll look at loan programs, the type of documentation we generally need for our home buying pursuit. We'll talk about assistance programs. There's going to be some kind of state-specific first-time buyer programs, but then we'll also look at more kind of national type programs. So depending on what state you're in, we'll kind of look at some of those programs. We won't be able to dive too deep into like local community programs, but I'll do my best to answer any questions you guys have during the session today. And then finally, we'll wrap up tonight's class looking at the process of buying. So, after tonight's class, I may say, hey, I really want to learn a little bit more about what a home buying plan might look like for me, because that's like my 2024 or my 2025 goal. We're going to be able to kind of give you the steps on what that's going to look like for you and kind of explain them more about like the pre-approval process and what to expect on this journey. Okay. All right. Thanks again for putting all your information in the chat. Again, you have questions as we go through tonight's class, just drop them in the Q&A and we'll get those answered tonight. So let's talk a little bit about home buying and does it really make sense for me, right? I think when we think about home ownership and compare that to renting, it's not necessarily that apples to apples comparison because there's a lot of great benefits that come along with owning a home. So when we think about it, we have the opportunity to create better affordability, hopefully for ourselves, because now we have stability in our housing expense. This is an asset that hopefully will grow over time. So as the value appreciates in my home, that creates more wealth for myself. This is an asset that hopefully will appreciate over time. So you can pass along this asset down to like heirs of your estate. And there still can be some tax benefits that come along with owning a home with the potential deductibility of interest. And so when we compare all of those things within ownership, I think it's really important to understand like how that can help complement my financial growth. But I still do think it starts with budgeting for home ownership. And so what we like to do in our classes is kind of launch into more of a budget discussion just so we can better understand like what are all the things that go into home buying that I should think about. They're going to impact my budget, whether good or bad. So I'm going to walk you guys through a calculation right now, and it's going to be through the Freddie Mac website. By the way, I didn't mention this to you already. I didn't mention to you earlier, but all of our presentation material, we're going to go ahead and send that out to you via email tomorrow morning. So we encourage you to take some really good notes and, of course, ask all the questions you have. But all of our presentation material will be sent back out to you tomorrow morning as well. And we are recording tonight's video too, so we'll have that up on our YouTube channel tomorrow as well. So if you want to kind of just do a listen back, you have that opportunity too. So let's look at the budget. And this is a calculator that we're going to first talk about renting versus what it can look like on the buy side. So we've kind of pre-filled in some of the sections just for time purposes for tonight's class. We have a pretty large audience, so I want to keep us on track as much as possible. So the way this rent versus buy calculator works is that we're going to plug in, first of all, a rent scenario. So if I'm renting for $2,000 a month, we're going to have the rental column and then we're going to have the buy column, right? So if I rent for $2,000 a month, I probably have expenses like renter's insurance. You may have some other, expenses in the community. You have utilities and whatnot. I'm not going to put utilities into the equation, but let's add in rent. We have the renter's insurance, and then we're going to assume that our rent will go up about 5% every year that I decide to renew that lease. All right. Now, from a buying perspective, let's say I'm going to purchase a home for $450,000. I know those sales prices might look a little bit different for your own like local community that you're considering to buy in, but let's talk about 450 as kind of a baseline number for tonight's discussion. The minimum down payment to purchase a $450,000 home is 3%. We're going to learn a little bit more about that in our products section in just a bit. And then we have property taxes. Property taxes do vary by the location of the property that you're going to purchase. And generally the baseline number that we use is 1.25% of the sales price. But, I know one of our classmates is joining us from Houston right now, right? So taxes in Houston might be a little more expensive than they might be here in California, right? So those are variances that we'll have in the numbers. And then we have homeowners insurance. We have maintenance costs. And they're going to be part of the equation. So we want to factor that in, especially if we buy an older home, right? We want to kind of plug that into our equation. We have loan information. Now we're going to learn a little bit more about loans in just a bit, but for this assumption, we're going to look at a 30-year fixed mortgage. We're going to assume a rate of 6.5%. Now we have origination charges, which those are the costs that you'll pay for your financing, and that varies by the lender that you choose. One of the things that we offer here as our APM and Georgia Tech alumni partnership is you get discounted services from us in working with us for a home purchase or refinance. So we actually discount our services by $750 to make it more affordable for you. Now there's other closing costs involved depending on what state you're purchasing in. There's attorney fees, title fees, escrow fees. Sometimes there's government transfer taxes. There's a whole variety of things that come into what we call as closing costs. Closing costs are usually about 2 to 3% estimated of your sales price. But as I tell first-time buyers, it not generally, but it does depend on what you negotiate with a seller in your contract. Okay, we'll talk more about that later on in tonight's discussion. And then we have discount points highlighted here. Discount points are when you as a buyer have the opportunity to bring down your interest rate by paying additional funds out of pocket. So I'm not a huge fan of discount points right now, just because those that are buying in today's market, there's probably going to be an opportunity for them to refinance in the next 2 to 3 years, where the break even mark on discount points is usually about 2 to 3 years. So it probably doesn't make a lot of sense to put those additional costs outlined. Now, a discount point, what a discount point means, it's a percentage of your loan amount. One discount point is the equivalent of 1% of my loan amount. So if I finance $400,000, 1% is $4,000. And usually that 1 point that you pay will bring down your interest rate about 1/4%. Okay, so that's where, kind of to my point earlier, the return on investment really isn't there in today's market, especially for that short-term relief of payment. And then we talked about other settlement services just now, about attorney costs, title, escrow, depending on the state I'm going to purchase in. And then finally, we make some other assumptions. So in this scenario, we assume that our home will hopefully appreciate 4% on an annualized basis. And for kind of the comparison I'm going to take you through, we're going to say that we're going to be in this house for 7 years. Now, the longer I stay in my home, the more appreciation I get over time. But for this example, we'll say 7 years. We have the cost of selling our house, so the commissions paid to realtors, not only just on the buying side, on the listing side as well too. We have state and federal taxes, and then finally the savings rate, right? So when we compare renting versus buying, first of all, the rent we know is going to be a lot cheaper than buying right now. So renting is about $2,000 a month, but we are just putting $2,000 into potentially someone else's mortgage, right? But if we purchase, we're going to look at a budget that's like $3,700 a month. So we're elevating that. We have to make sure that makes sense for us. But at the same time, we want to look at the opportunity costs over that 7 years, right? So even though I'm elevating my expenses by $1,700 a month, there's about a $44,000 buying opportunity versus renting right now. Now, how did I get to that number? Well, that number includes my interest potential deduction, right, through my taxes. But more importantly, that includes appreciation over time. And we're going to talk more about the housing market in just a bit, but there's, when we think about the budgeting of home ownership versus renting, I think that's where we really need to factor in the whole equation, right? So, and buying is not for everyone right now. So I know everyone's not in a financial position necessarily to purchase, but I think as you're building some strategy and plans and objectives for future buying, I think it's really helpful to understand those budgeting numbers. Now, let's talk about the housing market. I asked all of you to kind of put in the chat where you're joining us from. You guys are star students because everybody put their information in, so I really appreciate that. And when we look at the national housing market, it's going to look very similar to your localized markets, because we're now moving into the spring buying season. I think most of us are experiencing a little more warmth in our climates. I can't say everybody's experiencing that, but we are starting to warm up, right? So then the better weather will start to bring more people out to look at homes. And the challenge we've had in the last year and a half was just lack of inventory in the markets. But right now we're starting to see inventory pick up. The latest estimates we saw from Redfin was that inventory will increase about 10% year over year this year. So very good sign there. What we've faced as challenges in the housing market in the past year and a half is that, most homeowners that have existing mortgages, well, those rates were at probably 2.5%, maybe 3%. So if I'm an existing buyer, I probably don't want to trade out that for a 7 or 7.5% rate loan. It just doesn't work for me. So that we've kind of had this log jam when it comes to inventory, but hopefully that will open up over the course of 24 and into 25. But this is kind of what that housing market looks like right now. So you're seeing median prices kind of coming up a little bit year over year. That's just a simply supply and demand situation, right? Demand still remained really relatively high, even in the 7% rate environment, but we had limited supply. And so a lot of buyers had to turn to new construction and other options because they just couldn't find what they were looking for in the resale space. But I do think this housing market will start to improve over time. I think it's just a question of how many options we have out there for buyers. I think everyone, I was telling a first-time buyer this earlier today in a consultation, which is everybody wants the perfect storm of home buying, right? I want my lowest rate. I want my lowest purchase price. But the reality is we're not probably going to be able to achieve those goals because it just doesn't exist, right? Even in the 2.5% rate days, which you can see, well, actually not shown on this slide, but going into the 2.5% days of 2020 and 2021, homing prices were still rising, right? And so we still couldn't achieve that goal. But I think at the end of the day, if we can find an affordable level for us as future home buyers, that's really the goal, because hopefully your home price will achieve appreciation over time that's at a reasonable level. Now, interest rates are a hot topic right now for everyone, because clearly we're in a high inflationary environment. That's why interest rates are in the position we are at today. The Federal Reserve has been elevating interest rates to combat inflation, but we have seen some kind of slowdown in interest rates, which is a good sign. There is, thoughts that there is a projection for the Federal Reserve to cut interest rates at the June meeting, which would be a welcome sight for prospective home buyers to bring interest rates down a little bit. I do think we'll start seeing interest rates start coming down at the midpoint of the year. Right now, the average interest rate is somewhere around 6.6 to 6.75. That does vary by the day. Our hope is that we'll hopefully see interest rates move down into the low sixes by the end of year, and then maybe break underneath the 6% level into 2025. I hope I'm wrong. I hope it's even quicker than that, but I think that's kind of where we're projecting numbers at this point. This screen kind of shows you what a snapshot of rates look like over the last 12 months. So this little peak here, the mountain peak, is not an exciting number there, because that's when interest rates hit 8%. That was on October 21st of 2023. Not a good day at all, because that obviously changed the landscape of home buying for a lot of our buyers. But then we did see interest rates really drop off a cliff, so to speak, going into the end of the year. And so we'll see interest rates will still kind of bump around a little bit this year, but we do expect them to probably reach into the low sixes by the end of 2024. All right, so that's on the interest rate side, but I think it's important to understand that interest rates aren't the same for all clients, because many of you who are kind of exploring home ownership, maybe talking to your friend or a colleague or a family member about maybe what their interest rate is. And I think, as you hear that, or you're doing a Google search, you might not understand completely what goes into interest rates, because they're not all the same for the same lenders. They're not the same for each buyer, because there's things that go into the makeup of an interest rate, like credit eligibility. The higher my credit score is, that could change my interest rate offering, the type of product I have, how much I decide to finance, what my down payment's going to be. If I'm putting 3% down on my sales price versus 20%, that's going to make a big difference from a financing perspective. We talked about discount points earlier. So I may have got a 5.5% rate, but what maybe I didn't understand is that I had to pay $15,000 to get that 5.5% rate. So those are things that, could impact what my outcome of my interest rate looks like. And then finally, the term of my loan. So generally, the shorter my term is that I'm going to take in my financing, the cheaper my interest rate expense is going to be. But as we work with our clients during consultation sessions, we're going to figure out the right product that works best for you and go through the different interest rate options, because interest rate is going to make up what your monthly budget is going to be, and obviously shape your affordability for homeownership. So we really want to help you understand what your options look like from a rate perspective. Now, probably the biggest influence on interest rates is credit, right? Credit controls the product you're going to be able to obtain as a buyer. The interest rate offering that you have as a buyer also can affect your mortgage insurance as well, too. And you're going to learn about that in just a bit. I want to kind of walk you guys through credit and just help you understand maybe some things that maybe you weren't aware of from a credit perspective. And the first thing is, there are 3 different credit models to credit scoring. And there's credit card model, which is going to be usually used for most of your monitoring tools like Credit Karma. There's the auto model. If you go to finance a car, which, by the way, don't go buy a car if you're thinking about buying a home in the next 6 to 12 months, because that obviously could change your budget. And then finally, there's the mortgage model for credit, right? And that's what we have displayed here. So let's kind of walk through the weighting of that model. 15% is going to be how long I've had credit. So the more mature my credit file is, potentially the better my score could be. 20% is going to be how much new credit am I trying to get access to? Am I opening new accounts? Do I have new hard inquiries on my credit? The more I do that, the more my credit score decreases. And that's 20% of the weighting in the credit model. Now, there is a difference between hard inquiries and soft inquiries. As you start the process with our team here, we're only going to do a soft inquiry. And the reason our logic behind that is because we want to make sure we can inform you about home buying, but not have the impact to your credit score initially. Because a lot of our first-time buyers, it's not a get pre-approved today, go buy a house next weekend. it's a process, right? It probably takes 6 to 12 months for a first-time buyer to kind of find their way in the market. So we don't want to have that impact in your credit score. Now, there are rules in place for hard inquiries that state that if you do one inquiry today with lender ABC, you have a 30-day window to apply with as many lenders as you want, and that's the equivalent of one credit inquiry hit to your score. Okay, so those rules are in place for mortgage financing as well as auto financing. Okay, now 30% is going to be credit utilization, and we're kind of spotlighting revolving accounts. So credit cards, lines of credit, any type of revolving account. So what we mean by that is I have $10,000 in credit limits and I'm at $5,000 in credit balances, I'm at 50% utilization, right? Now, the rule of thumb to optimize your credit score is to be below 10% utilization. So in theory, I would want my balances below $1,000 to optimize my credit scores. So clients that are at 780, 800 plus credit scores generally are at that 10% utilization of credit because they've really kind of got their utilization into the lowest point, level possible, right? Let me give you a quick tip on how to better manage utilization of credit. So as a homework assignment tonight, so you may not want to do this tonight, maybe tomorrow, but get a chance to pull out like a PDF statement of your most recent credit card. And I want you to take a look at two dates. There's a billing cycle date. There's also a due date. The billing cycle date is the date at which the credit card issuer is going to report your account information to the credit agencies, right? Once that billing cycle closes, then that data gets reported. Your due date is usually 4 to 5 days after that, right? Now, if you're in the habit of paying on your due date, there's nothing wrong with that. But the problem can be is that you may be paying off your balance on your due date, but it's too late, right? Because that information's already been sent out to the agencies. So if you're trying to maximize credit score, try to pay off your cards down or off by the end of the billing cycle date, because that'll help lower that utilization, give you a much more improved credit score, and hopefully change your qualifying opportunities. Finally, payment history is the last section of this model, which is how have I paid my bills, right? So if I've had any late payments, they're going to be rated as 30-day late, 60-day late, and 90-day late delinquencies. The lates that I've had in the last 12 to 24 months are going to be the most impactful to my credit score. So, if I've had a late back in 2023, as I move kind of further away from that late payment, the more my score should start to organically improve as long as everything else has kind of stayed relatively the same. In lending, there are minimum credit scores by product, right? So, and we always take the middle credit score of the three agencies. So the three agencies, as you all know, are Equifax, Experian, and TransUnion. If I'm at a 740 as my high score, my middle score is 720, and my lowest score is 700, as a lender, I have to take the 720 credit score as the score for qualifying purposes. Now, if I'm at 720, but my partner has a middle score of 680, then that 680 score is what's used from a qualifying standpoint, because that's the lowest middle score between the two of us. So that's just something to be aware of when it comes to qualifying. So I get that question a lot, especially from buyers that are looking to add co-signers. If their score is lower than my applicant's score, then that could maybe negatively impact the options for the client. Things like bankruptcy, short sales collections, some late payments. We talked about late payments, but those are all negative items that will have impact to the credit score. I'll show you a matrix in just a minute about how long those events will stay with you on your credit report. And the last thing I want to kind of share with you on this page is around account closure. And account closure impacts your revolving accounts. So if I close out a credit card, and let's say I've had that card for 10 years, I close it out, that means I'm now no longer using that card. But what it does to you from a credit perspective is it takes away all the 10 years of history that you've had on the credit bureaus. So it hurts the 15% length of credit, but it can also hurt your utilization of credit. So we want to be really aware of that, because that could have a negative impact on your credit score. So we had a question in the chat I want to just share with the group. So the question is, how does the interest payments on your house affect your taxes? So with some of the federal tax changes in 2018, taxes were no longer allowed to be deducted on your mortgage. So unfortunately, that would not provide any impact to your taxes. Okay, let's go ahead and take a look at the credit matrix for negative items on your credit. So this is what that looks like for you in terms of how long negative items will stay with you on your credit. Hard inquiries will be there for 2 years. In hard inquiries, we're really looking at the last 6 to 12 months that those negative or those credit inquiries have been on your credit. The most recent 12 to 24 months is just so impactful to your credit score from the date of the event. Things like bankruptcies, tax liens, those will generally be on your credit report for the next 7 to 10 years. Okay. All right, let's talk a little bit about student loans. And student loans, I know for most of us are in repayment right now, especially if you have federal student loan debt. Now, as a lender, we look at those from a couple different angles. If you're on an income-based repayment amount, we use the IBR payment for qualifying purposes. So if I have $75,000 worth of student loan debt and I'm at a $250 IBR payment, that's the amount we use from a qualifying perspective. Now, if I haven't signed up for an IBR payment, or maybe I'm still in school and I'm not in repayment and I'm trying to qualify for a mortgage, we still have to use an amount for qualifying on the student loans. So on a conventional loan, it's 1% of our aggregate balance. For an FHA loan, it's 0.5% of my aggregate balance. And we're going to talk about programs in just a second, but I want us to be aware of that. Some of our clients may have student loan forgiveness or might be in a situation where they're working for a nonprofit for 10 years and then there's forgiveness. If I'm in year 2 of that forgiveness, I still have to count a minimum payment for you as in terms of qualifying from a student loan perspective. So if you're in forbearance, deferment, or anything, there still has to be a minimum payment that we qualify for on those student loans. So question in the chat, and then we're gonna keep it moving to our loan program section, which is, what do we think of in terms of strategically getting credit cards that serve short-term goals, such as honeymoon expenses or to get travel? So basically getting rewards, and then canceling those credit cards. So that's a really good question. I haven't had that in a few workshops. So what we're talking about here is that someone, say I'm at the register paying, right? And I get offered to open up a credit card and get a 10% discount by applying for something, right? While that 10% discount is really appealing, if I'm spending $100, I get, $10 off, right? It may not be worth it, especially because you're going to be opening up new accounts, which is going to start impacting the 20% threshold of new accounts opened, right? For the trade-off of getting a $10 discount. I don't know if that's necessarily worth it unless you feel like this is a long-term card you're going to use, because the more accounts you open up, the bigger impact you're going to have on your credit score. And then another question on student loans is, if we're in a 1 year away from being in a tax-free forgiveness on student loans, how does that affect the qualifying? So if you're trying to apply now for a mortgage financing, even though it's a year away, it will generally be counted still as debt in qualifying. Now, there is a rule in financing, and we'll have to kind of maybe talk offline about your specific situation, but on installment debt, if you have only 10 payments remaining on installment debt, once you hit 10 payments remaining or less, then we don't count that installment debt in your qualifying purposes. So for our question here, once you got to 10 months remaining for forgiveness, there is a chance that we might not have to count that student loan into the calculations. All right, let's talk about loan programs. We always like to kind of spotlight 5 products that are available to you as buyers. Not all these programs will be necessarily fits for you in your journey to home ownership, but I want to kind of give you a little bit more about these programs. So let's start with conventional loans first. Conventional loans have a minimum down payment of 3%. When you think about conventional loans, those are Fannie Mae, Freddie Mac loans. So you guys have probably heard that terminology in the past. The minimum down payment is 3% up to a loan amount of $766,550. So one of our guests that I know is joining us from the Bay Area in California, that loan amount looks a little bit different in the Bay. So you can go up to $1,149,500 in the Bay Area because that's considered a high cost of living market. Now, when we go up to those high cost of living markets, that minimum down payment jumps from 3% to 5%. So that's called a high balance loan. But across most of the country, it's a minimum down payment of 3%. But like I said, high cost of living areas will have a different threshold of loan amount. So that's the conventional product. The conventional loan has a minimum credit score of 620 for most clients. And so that program is going to give you options to have that lower minimum down payment. but it won't have as much flexibility as some of the other products that we're going to talk about in just a bit, which would include the FHA product. So FHA has a slightly lower credit score threshold of 580, same loan amount threshold for the most part. However, FHA loan amounts are set by county. And so it will vary on where you're purchasing with FHA across the country by county. Now, FHA will have a little bit more flexibility in the underwriting guidelines. So if I missed a payment on my student loan last year, it might not be as big of an impact to my qualifying versus if I was trying to apply for a conventional loan, because conventional is really going to look at strong credit history, especially in the last 12 to 24 months. So even though I'm at a 620 credit score for conventional financing, if I did have that late payment last year, that might impact my eligibility, whereas FHA might have a little bit more flexibility there. For our VA product, that's going to be for our veterans that are eligible on the VA home loan. The VA home loan is a fantastic option for our veterans that have eligibility. Those veterans will have a certificate of eligibility that we use as lenders to kind of build their financing. What's really cool about the VA product, it is a zero down payment option. So whether I'm going to buy a house for $1 million or $300,000, I can have a no down payment option. And in some states like California, if I am a veteran, not only can I get 100% financing, but I can also get state assistance that can help me with things like closing costs for my home purchase. The VA product, for the most part, goes down to a minimum credit score of 620. And then on the right side of our screen, we're going to talk about two other products, which would be the USDA product. That is the United States Department of Agricultural product. That is for our clients that want to buy in outlying areas. Usually it's a minimum credit score of 620. That too does have 100% financing, but there's two kind of major requirements for USDA. It has to be a designated USDA area, but there's also income limits by the household size for the USDA product. But USDA will look very similar to an FHA product in terms of the mechanics of it. USDA charges a guarantee fee as part of the financing and also a monthly guarantee fee. And then finally, the jumbo loan product. Those are for clients that need a little bit more buying power outside of the standard loan limits. With jumbo loans, there's higher credit score requirements, which are usually about 680 and above. Down payment requirements are 10 to 15% usually. And added on with the jumbo loan is what we call as reserve requirements. So I not only have to save my down payment and my closing costs, but I also have a thing called reserves, which reserves are going to be additional assets that I have left behind after I've contributed my down payment and my closing costs. Usually the reserve requirement is about 12 months of my equivalent of my mortgage payment. So if my mortgage payment's $7,000 a month, I need another $84,000 in assets. All right, before we move on, and we're going to talk about PMI in just a second, I want to answer one of the questions in the chat, which is, are there any changes for buyers that are on H-1B1 visas? The guidelines don't change necessarily for immigration status. So Fannie Mae does recognize H-1B1 status as eligible buyers. Now there is various, obviously, statuses with immigration. So you would want to kind of check in with us, maybe offline or maybe give us in the chat kind of different statuses that might fit your situation. But there's a kind of a variety of different scenarios that can work with Fannie Mae and FHA loans. All right. Okay, let me just make sure I got the chat, and we're going to talk about PMI. Okay. All right, so let's go ahead and talk a little bit about PMI. So you guys have heard about PMI. It stands for private mortgage insurance. What PMI does is it insures the lender, in essence, against default by the buyer in case something happens with payments, right? Now, there's different ways of looking at PMI, and there's different ways the products are set up with PMI. So I want to first talk about conventional, and then we'll move over to FHA. We'll kind of do a quick cross comparison. So with conventional loans, there's different ways to pay mortgage insurance. This can be paid monthly. It can be paid as a split payment where you're paying some of it upfront, some of it monthly. You can also basically buy out the mortgage insurance as kind of a one-time payment, so to speak. And there's also lender-paid mortgage insurance where you're in essence taking a higher interest rate than the market rate to buy out the mortgage insurance. 95% of our clients are going to elect the monthly MI option. The reason for that is because conventional mortgage insurance has a cancellation option on it that says that if I have 2 years in this loan and 22% equity, I can apply to have the mortgage insurance canceled. So that's why most clients will go with monthly MI. Now, when you're doing searches on Redfin or Zillow, whatever the case may be, um, those calculators that you use on those sites are not going to have accurate PMI figures because they're not calibrated to these characteristics, which include credit score, down payment, and amount finance. Those are what make up your cost of mortgage insurance. So if we look at the PMI example at the bottom of the screen, if I finance $450,000 and I'm putting that 3% minimum down payment, I have a 740 credit score, my PMI is about $183 a month, okay? Probably a lot less than if you went into Redfin right now and did a calculation because we don't have those characteristics built in. Now, the higher my credit score is, the more I put down, the less I finance, the less my cost is going to be with mortgage insurance. So that's conventional mortgage insurance. Let's talk about FHA mortgage insurance, which is completely different. There's two forms of mortgage insurance with FHA loans. There's upfront mortgage insurance, which is 1.75% of my loan amount. That gets added into my amount financed. There's also monthly mortgage insurance, which is the equivalent of 0.55% of my loan amount. And then we divide that by 12, and that's how we come up with a monthly payment figure. So if we look at the scenario with FHA, I take the same 450 loan amount. I have my PMI now at 206 a month, plus we add on upfront mortgage insurance of 78.75. So now I'm financing a little bit more money. It's important to note that on FHA mortgage insurance, there is no cancellation option. So even if I achieve my equity requirement, I have 2 years on loan, the only way to exit FHA mortgage insurance is if I refinance out into, say, a conventional loan in the future. And for a lot of our clients, that is going to be the strategy because FHA is not a long-term loan from my perspective. It allows us to get into home ownership that's hopefully affordable and be able to transition to a conventional loan whenever we're maybe in a better credit position or maybe we have a little bit more equity. FHA, as compared to conventional, as you heard me talk about earlier, has a lot more flexibility in it, even though the expense ratios might be higher. The flexibility that we have within FHA allows clients that have had, maybe a delinquency in the last couple of months to be able to still get financing, or let's say I had a bankruptcy that was 2 or 3 years ago, FHA would still be an option, whereas say a conventional loan might want to see 4 years outside of a bankruptcy. Okay, let's talk a little bit about documentation as it relates to home buying. So as you're, learning a little bit of these kind of concepts in tonight's class, you may be thinking about, well, what do I need to put together financially if I want to kind of look at my home buying options? Well, it's pretty simple. Generally, you're going to need the last 2 years of taxes and W-2s, the last 30 to 60 days of pay stubs. We do verify asset statements, so checking and savings accounts, any accounts that you think you might be using towards your down payment as well as your closing costs. Now, we're going to learn about assistance programs in just a bit, but I want to kind of get you thinking a little bit about some of the documentation that you might need. Now, let's talk a little bit more about income as it relates to home buying, because we get a lot of questions around eligibility from buyers. And so I thought I would kind of talk through that a little bit with you. So there is a 2-year rule in place for employment/educational history. So maybe some of us that are newly graduated from Georgia Tech that are just kind of getting started in our careers may not think they can qualify for financing, but it's really not the case because the way the rule works in mortgage financing is I have to have 2 years of employment history and or a combination of education. So if I graduate in the fall and now I've just started my career the first of this year, with my 4 years at Georgia Tech plus my new job, I could use my new income for qualifying purposes. The 2-year rule in essence means that I have to put together my education or my employment history. And so that's kind of what that looks like. And so I could even be transitioning jobs from, my current job and I have a new prospective job. I could potentially even qualify with my new job as long as I had an offer letter for my home financing. Now, where 2 years employment history gets a little trickier is if I have dual employment. We see this in some professions like the healthcare industry, right? So if I'm an RN and I work at multiple clinics, maybe 20 to 30 hours or 40 hours a week, if I want to include both streams of income, then in that case, I do have to show that I've been on both jobs for 2 years. The case also holds true that if I have a 40-hour work week job, but I also, maybe drive for Uber on the sides, right? And I want to make sure that I can include my Uber income as well. In that case, I would have to show that I do both jobs simultaneously for the last 2 years because we want to make sure it's sustainable. And that's why the guidelines are structured as such. Now, if I'm self-employed, the guidelines look a little bit different because I have to show that I've been doing my job for 2 years as a self-employed individual. That includes independent contractors, that, are filing as a Schedule C sole proprietor, or if I have a business, LLC, S Corp, C Corp, all of that applies as a 2-year requirement. Okay. Do we have any questions on income documentation or anything like that I can answer from the group? Now we have a few things in the chat. I think Ken's answering a few of those. Okay. All right. I want to make sure I keep you guys on track for tonight's class. One thing I want to add on to the income section is that if you have additional sources of income, so let's say your partner contributes to your household expenses, but does not plan on being on your application, the only way I can include your partner's income is if the partner is on the application. Or let's say I have rental income from, I have a roommate, right? And they're paying $500 a month in rent. Well, if I can't use that income to help with my home buying. That would be income that would stay with the rental situation. So those are things that come up in our conversations with clients as we're building home buying plans. Okay, let's kind of stay with the theme of income, and I want to kind of walk you through a calculation that us as lenders use, and it's called debt to income ratio. And what debt to income ratio looks is your gross monthly income versus your monthly expenses. So we're looking at expenses like credit cards, personal loans, auto loans, and the new mortgage payment. And I'll kind of let you know what that looks like in just a second. It is based upon pre-tax income. So generally, we don't want those expenses that I've noted to be more than 43 to 45% of that total income. Now, at times we can go as high as 50% debt to income ratio, but those are on rare cases because we really want to make sure that we're designing an affordable housing plan for us. And so this is kind of what that calculation looks like. So we look at the principal and interest of the new loan, the property taxes for the house. We talked about that earlier. We talked about homeowners insurance, PMI, which we've examined a little bit. And then if I'm buying a condo, maybe a townhouse, I want to factor that into my payment budget. So let's say that's $2,500 a month. And then my other expenses like my car payment and credit cards are $500 a month. So if I'm making about $8,500 a month, my $3,000 expenses consume about 35% of my pre-tax income. That would be well within qualifying guidelines. The question I get from clients, in fact, I got this question just about an hour ago, which is where should my debt to income ratio be? Most first-time buyers feel good around 33 to 36% debt to income ratio. Now that does vary by, each buyer, but for the most part, we've seen about 33 to 36% to be kind of the comfort level, so to speak. Now, if I'm buying in the Bay Area in California and I know what cost of living looks like, my debt to income ratio might have to be a little bit higher just because where I'm buying, as opposed to maybe I'm buying in a lower cost of living, maybe say in another part of the country. So those are all things that kind of go into the calculation that we want to kind of talk through during your home buying plan. What I think I saw a question in the chat. I want to just address it really quick. So the question, because we get this up a lot too. So marital status doesn't have any impact on qualifying. So whether I'm, in a partnership, a domestic partnership, I'm legally married, that doesn't impact your qualifying. So the question in the chat was, can both of us be on the application if we're married? And so absolutely, the answer is yes. It's just we will factor in credit for both borrowers, income for both borrowers, and any type of obligations. So just because you're not legally married doesn't mean you can't apply for credit simultaneously or together. Okay. All right. That's a good question. I'm glad that got answered in the chat. All right. So the question in the chat, and then we're gonna move in to talk a little bit more about assets, is just around student loan debt. I think we're gonna go back to that, which is it. So the scenario is if we have 150,000 of our debt, but it will be forgiven in a year, should we wait on buying, or should we look at options now? So the question's going to be like, what does our budget look like now? Does it make sense for us to buy right now? Can we buy what we're looking for now, or do we need to wait because maybe the obligation's a little too much in today's expense situation? So I would encourage that person to get connected with us for a home buying plan. Let's put together a plan, and then once we get done with that session, we may say, yeah, let's do it now, or let's kind of build for a 2025 plan. And that's kind of a good kind of segue into some of our consultation, which is the consultation is a free service we provide to our alumni to make sure that you're going to be in the best possible position. So you have a roadmap to home ownership. That road doesn't have to lead to buying now. It could be a 25 or like a 26 plan too. That's totally fine. All right, let's talk a little bit about savings for down payment. And, I know all of us, we're trying to get ourselves in position to save for home ownership. We learned earlier that the minimum down payment is 3% on that conventional loan. And so we're going to talk about assistance programs to help you kind of get to that next level of home ownership. That could be another support mechanism for you. But as we think about assets, we're going to have to save up for our down payment and our closing costs, which we know are, somewhere estimated at 2 to 3% of our purchase price. But we have to document all assets that are used in home buying. So this is what the form of documentation looks like. I think the takeaway on this slide for our audience here is that any assets used in home buying, they have to be seasoned at least 60 days. Okay, so whether you're using a checking account or a savings account, if you've had any regular deposit or whatever, we're going to have to paper trail any deposit used in the transaction. You can potentially also use 401ks, 403bs, IRAs. I would just encourage you to talk to your tax or financial advisor before you get into those assets, because we don't want to create any tax consequences or limit your upside of appreciation in some of those brokerage accounts. And gift funds can be also used in home buying. So that's where a family member is, helping you out to be able to kind of close the gap for you with down payment and closing cost resources. Now with gift funds, they don't have to be seasoned 60 days. So, your uncle could say, hey, Jason, I really want to help you out with home ownership now. So I'm going to help give you $10,000 towards your home ownership goals. That can be completely allowed right now. We have to document that, as you can see on screen, but that's something that does not have to be seasoned the 60 days. Okay. Now, we understand the challenges of home ownership and the savings. We are in a high inflationary environment, right? So, it's not anything that we're not keyed in on, right? So, as I work with clients, whether they're in Georgia or the Midwest or out in California, things are more expensive these days, and home ownership is not alone with that. So we understand there's challenges with savings. We work with clients on savings plans, and we would encourage you to, connect with us on something like that, where we can help build savings plans to help reach home ownership. But in the short term, if you're still looking to pursue home ownership, there are some phenomenal first-time buyer programs that are available to you across the country. I'm going to spotlight a few of them on today's session today, but I would encourage you, get connected with us offline to learn a little bit more about the support that's available in your local markets. From a national perspective, Freddie Mac and Fannie Mae, which you learned about the conventional products, offer grants towards low income buyers up to $500 to $1,500. It may not sound like a lot, but it can really help offset some of the ancillary expenses that come along with home ownership, because we want to create a lower cost option for you. In the state of Georgia, there's the Dream Home Ownership Program, creates affordable housing options for you for low and moderate income residents of the state of Georgia, and down payment assistance options that can be anywhere from $10,000 to $15,000. So, if you're interested in purchasing I know we have a lot of guests here in Atlanta. So, if that's something that would be of interest to you, we can help make that part of your home buying plan. I know we also have residents of California on tonight's session. And so in California, there's a variety of different assistance programs that are also designed to help low to moderate income households. There's a variety of different programs offered through Cal HFA, which is the California Housing Finance Agency here in the state of California. There's new programs being kind of rolled out all the time, one of which is called the Dream for All program, which provides a first generational buyer access to up to 20% of their purchase price, or $150,000, whichever is less. For those, I know we have a few of you from the Bay Area here join us tonight. So if that's something that of interest to you, we'd encourage you to get connected with us. And, classes that are specific to first-time buyer programs, and I'll give you some of our information on YouTube. You can check out some of our videos on some of those first-time buyer programs at J Meda Mortgage as well. Okay. We're going to kind of start going towards the latter part of tonight's class, talking a little bit more about the buying process. So as you're leaving tonight's class and you want to kind of understand like what comes next after a class like this, well, we want to first get connected with you for a consultation, but the outcome of that consultation is a pre-approval, which basically signifies that you're eligible for your financing. So we kind of create like a baseline number for you. So whenever you do decide to go out and go home shopping, whether it's next year or this year, you know what kind of that looks like for you. A pre-approval is good for 60 days, but it can always be recertified at any time. And it only starts with a soft credit check. So, like a lot of our questions that have come in the chat about should I buy now, should I wait? I would encourage you do the consultation with us. If we get you pre-approved, great. If we have to kind of push things back a little bit, that's okay too. At least we can get a little bit of a roadmap and set some goals in place for you. Step two would be house hunting from there. That's when we get a chance to go look at homes in our local market. I would encourage you talk to a realtor. They should be an expert in their market and be able to help guide you to options that fit your budget and hopefully help negotiate a successful transaction for you. Now, if you get an accepted offer with a seller, then you move to step three. And it's called entering escrow in most markets across the country. But ultimately, what it means is that you have a seller that you've come to an agreement with, right? That process after the acceptance by the seller usually takes about 30 days. So by the time they accept my offer to when I get my keys, it's about 30 days. Now, there's some action items in place once we get that offer accepted. One is you're going to get a call from me to say congratulations and talk to you a little bit about next steps and schedule you for your follow-up consultation. But as a buyer, in the first few days, you're going to have to make a deposit on your house to secure that house and show some financial interest in the property. It's called an earnest money deposit for the most part across the country. It's usually 1% to 2% of your purchase price. It goes as a deposit towards your total out-of-pocket expenses. The important part of the deposit is that it's contingent upon things like the appraisal being done, your inspections being completed, and getting your loan approved. So in most markets, it's going to be protected by a contingency period that'll be part of your real estate contract. So we want to make sure that you can do your homework on the property confidently and know that you're not putting yourself at financial risk to make sure really the property is a good fit. Step four is processing and underwriting of your loan. Those are the administrative tasks of the loan. That happens after we've done your follow-up video consultation with you. You've locked in your rate by that time, which protects the rate for the duration of the loan. And then we submit everything to an underwriter, which basically completes the loan approval process. And that'll take us about to 3/4 of the way through the process. At step five, we have a loan approval. We've also received the appraisal back. We want to make sure appraised value of your home matches the purchase price of the house. Throughout the process, you get various iterations of disclosures that highlight your interest rate, your payment, your out-of-pocket expense. So there's no, no kind of like secret number, so to speak. You're going to have complete transparency of what everything looks like in your financing. And we go through that during your follow-up video consultation. At step five, we deliver a final closing disclosure to you, which gives you a 3-day cooling off period before you get to the very final stage, which is called closing of your loan. Different states have different kind of terminology for it, but ultimately what it means is you're signing final documents in person with a notary or an attorney or an escrow officer, and those documents are done in person. Everything up to that point, generally in most states, is all done electronically, like all the disclosures are done electronically. After that task is completed, then you wire in your final funds for closing. We also wire in the funds for our mortgage options, including like assistance programs if you elect those. Those monies get reconciled by an escrow team or attorney's office, and then documents get recorded with your local county recorder's office. They usually record a grant deed to transfer ownership to you and a deed for your loan for the repayment terms of the loan. And after that gets all confirmed, that's when you become the official homeowner of the house. And I get a chance to call every one of our buyers to congratulate them on that huge, huge monumental moment because it's a big deal, right? We have just a large audience attending tonight's class to learn about homeownership, and come from a class to then get the keys to your house. It's a huge financial accomplishment. So we want to be there to celebrate that with you. Now, as we're finishing up tonight's class, and maybe you're thinking about homeownership and designing your own home buying plan, we'd encourage you to get connected with us. It's a free service we provide. It's a 30-minute in-depth conversation with me over video, talking about credit, talking a little bit about the process, budgeting, maybe a savings goals, assistance programs, just a comprehensive view of what things could look like for you in home buying. And it's not some type of, it's like a non-commitment type of thing. So we just want to be a partner for you in designing a home buying plan for you. Now, if you have specific questions after tonight's class and want to get connected with us for a brief introductory call, maybe you have a credit scenario you want to run by us, or maybe talk more about a specific first-time buyer program, join us for an introductory call. I think that'd be super helpful for you. And this is kind of what that consultation looks like. So we're going to talk about, where am I buying? Am I buying in Atlanta? Am I looking in Denver? Where do I want to purchase in the country? And kind of we'll put that like kind of roadmap together here for you. Really set some goals and objectives for home ownership. I can't tell you how many people I get a chance to meet with that we're talking about 1 and 2 year plans, and that's totally fine. I think that's a smart thing to do, that as you're planning ahead for home ownership, because this is a big deal. Like I said, it's going to be the biggest investment you make in your upcoming financial futures. As we wrap up, I want to share with you a resource, our mobile app. I think it's a great tool for you to start the application process, but more importantly, do calculations to figure out the budgeting for home ownership. And you can also follow the progress of your application. I mentioned earlier when we went into tonight's class, you have a discount as being part of the Georgia Tech alumni, and attending tonight's class, you get $750 as a credit towards your closing cost to make home ownership a little bit more affordable for you. And we teach classes like this, as I mentioned, all across the country. So if you like tonight's content, you want to share that with your friends, family, or coworkers, we have classes throughout the year. You can visit mortgageeducate.com for the full list of all the classes. And you can check out, our classes that we have available next week, and all our recorded classes at our YouTube channel. Here's all my contact information. So if you want to get connected after tonight's class, you can reach out to me whatever way works best for you. We love what our clients are saying about us in reviews online and some of our social following. We want to make sure that we're putting good, helpful first-time buyer content out there. So you can see all our social username information. You can follow us on Instagram. We'll have some great information out there to help you on this journey. I appreciate everyone joining us for tonight's class. We're going to dive into some more questions before we wrap up. We'll stay as late as we need to get all of our questions answered. So I'm going to go ahead and take some questions in the chat and encourage you to, or in the Q&A, and I'll get those answered for you. So let's kind of dive in, and we have a large group still with us. So let me kind of take a look and see what we got here. So one question is, to qualify for the alumni discount, do you need to apply for home ownership at Georgia? So answer is no. So to qualify for the alumni discount, you just have to be affiliated with one of our partners, but you can purchase anywhere in the country that we can serve you. We did have a question, I think. So I don't know if there's any existing homeowners in tonight's class, but we did get a refinance question. But I think it's helpful for our audience to know what refinancing means as it relates to homeowners. So when you refinance, you're basically taking your existing loan, you're refinancing hopefully to a lower interest rate. That lower interest rate provides savings to lower your monthly payment. There is a cost to refinancing at any time, so it's not a no-cost option. Usually, refinancing will run somewhere between $3,500 to $4,000 in upfront costs, and that usually gets rolled into your amount financing. But you want to be careful in refinancing because there's about an 18-month break-even mark that we recommend, which basically means that you want to save at least $200 a month to have a good enough break even on your refinancing to make sense. So a lot of my clients that bought last year at 7%, we'll probably start thinking about refinancing when we get to interest rate levels that are at like 5.75 to 5.5%. All right. And then I was just asked to touch on the subject of maximizing down payments for better interest rates, no PMI. So let's kind of flash back a little bit. So as it relates to interest rates and down payments, so the larger your down payment is, potentially the lower your credit score could be. So how I kind of frame that up is, if I put 3% down versus 20% down, my interest rate's going to be better on the 20% down. Now, if I have a 760 credit score versus a 720 credit score, my interest rate will be better on the 760 score, because when we look at financing options, the pricing modules will look at down payment, credit score, and how much I decide to finance. So it is advantageous for us to try to put as much money down and maximize credit score to get the best financing options. Okay, great question, everyone. And then we had a kind of a secondary question to the alumni discount. So if you want to kind of look at all of our other partnerships that we have across the country, you can just check us out at mortgageeducate.com, because I think this person wanted to know a little bit more about the other discounts. So, okay, let me just make sure. Thanks for everybody hanging in there with us. I don't want to make sure get all of our questions. Okay, we have a question around credit, which is, do regular credit card bills count towards the debt to income ratio or just the credit card debt. So whatever shows up as the minimum monthly payment on the credit report is what gets counted into the debt to income ratio. So one of the questions I ask clients when I go through a consultation is that are you in the habit of paying off your credit cards every month? Because if your Apple card has a balance of $2,000 and a $50 payment, I don't want to count that $50 payment against your debt to income ratio if you usually pay that off every month, right? So we'll kind of walk through that during a consultation. But to answer your question, the minimum payment is what gets counted on the credit cards. I want to just bring up one thing on installment debt that I didn't talk about in the credit section. And we had this come up earlier today, is that if you pay off installment debt, like let's say you go out and pay off your car loan today, right? Usually we'll see, like, for the first 1 to 2 months after paying off the car loan, like your credit score will drop a little bit, but it will recover right back up as long as nothing else has changed on your credit file. So just keep that in mind. If you pay off a bigger installment debt, you might see an initial 45 to 60-day window of time where the credit score slightly pulls down a bit. All right. And then, so question in the chat was, with higher down payment along with an exceptional credit, does it help to reduce the interest rates? Is it advisable to pay higher down payments? I think we talked a little bit about that. So yeah, higher we can get our credit score, the more we can put our down payment. It makes more sense to, do that if we can achieve a lower interest rate. Now, if you're a first-time buyer and you're electing first-time buyer programs, especially in like the state of California, there isn't any adjustments in interest rates. If I'm a 680 credit score, I'm a 780 score. Those are all kind of flat pricing models, so they don't change the interest rates. But if you're a buyer that doesn't need first-time buyer programs and you're thinking, should I put down 5% or 10%? It is advantageous for you to put 10% down because the interest rate offering will be lower, so will the mortgage insurance. And then, of course, you'll be financing less money. Now, I would encourage you to kind of walk through that with us during a consultation, because then we can see if the math makes sense. Because if we only move the needle $100 in payment, it may not make as much sense for you financially to invest, additional down payment. All right, got great questions. All right, any other questions from our audience? I will have to say, Georgia Tech alum, you guys were best questions of 2024. So you guys have been a great audience tonight. So I really appreciate everybody kind of hanging in there and going through this. And yeah, really great to be able to present this to you. Well, I think we're there. I think we got everything answered. If you do have any follow-up questions, I would encourage you to get connected with me or our team. We'll be here to help support you in homeownership. Thank you so much for taking time out of your busy schedules to hang out with us. And we hope we get a chance to get connected with you for your upcoming consultation. Again, we'll have the recorded version on our YouTube channel at J Meda Mortgage. That'll be available tomorrow morning. And then we'll also send you out a copy of the presentation material. Look forward to seeing you all soon. Good night.